The Fed cut their rate by 1/4% last week. And I've been getting multiple questions or inquiries saying, hey, I heard that the rate is now 4.25, 4.25. And that's true. That is the federal funds rate. That's their target rate. So the Fed lowered their target rate to that 4 to 4.25% range. And that's to get banks trading money on their overnight window. That's the rate that they're trading money at now. And they control that by the money supply. So they actually can't set it at a particular rate. They set it at that range. And then that federal funds or overnight rate will fluctuate in that 4 or 4.25% range. Mortgage rates, interestingly, in the mortgage industry, we commonly tout that, hey, mortgage rates don't follow the federal funds rate. And it's like rarely over my 22 years, I've only seen it a couple times where the mortgage rates do the opposite of the federal funds rate. It happened last September 2024. The Fed cut, mortgage rates were low for a minute, and then they shot right up. Last week, federal funds rate was cut, and mortgage rates suffered a little bit after that. Now, ultimately, I think that's not the bigger trend that we're going to see. But certainly last week, the 10-year yield, the 10-year treasury yield, and mortgage-backed securities bonds suffered for a few days after the federal funds cut. And again, bigger picture, I think like what we're going to see in coming weeks and months is that mortgage rates are going to cooperate and they are going to move in a positive correlation with the federal funds rate. But a little bit of a trip and fall last week. And nothing major, but it's just interesting to see that reaction. And then the other piece of that is mortgage rates are not at 4 or 4.5%. So when you see the news headline that says rates cut to 4 or 4.5%, they're talking about the federal funds rate. That influences things like credit cards. It influences things like car loan rates. And most importantly, it influences things like how businesses are borrowing money. What rate are they borrowing at? And that's the whole point of that, is to encourage businesses to invest and increase hiring and impact employment. So the Federal Reserve's got two goals there. They're trying to encourage employment because the employment numbers say that it's suffering a little bit. And then simultaneously, they're also combating long-term inflation. And that's where 10-year treasury yields, mortgage rates, those are long-term yields. So while the Fed is using the federal funds rate to impact short-term yields, they simultaneously are keeping their balance sheet, the amount of money that they have sloshing around in the economy, they're keeping that tight, which is sort of holding long-term yields where they are, or stopping them from coming down. Because if there's still long-term inflation concerns, then you wouldn't want those long-term yields to come down. You want those long-term yields to stay with or outpace the inflation concerns. So the Fed did not, do any easing on their balance sheet last week. If anything, they tightened, and they were kind of getting pulled in two different directions there. So that's sort of, in a nutshell, what happened last week. And most importantly, just that the mortgage rates did not drop to 4 or 4.5%, although we're praying we're going to see that. And I have my fingers crossed that will take some time to get there. But certainly seeing rates in the low sixes and high fives, depending on discount points and APR. So that's exciting, and we're heading in the right direction. But I know it can be confusing when you're getting mixed headlines, especially if you're a borrower going through the process right now. So I hope that's helpful. Have a great day. Thanks.